There's no doubt in my mind that one of the most valuable planning seasons of your life comes in early retirement. I'm talking about those years between the ages of 55 and 75. And while compounding has been called the eighth wonder of the world, I'd argue that tax planning has been overlooked and is one of the most important things you can focus on that can add value over your lifetime. But unlike other more straightforward aspects of your planning, this one comes with a lot of nuance and a number of twists and turns. In this video, we're going to discuss a framework for understanding and thinking about retirement tax planning, and we'll take a look at an example of what I'd call a micro view of tax planning opportunities. But first, I'm Curtis Crossland of Suttle Crossland Wealth Advisors, and the purpose of this channel is to discuss financial topics and ultimately help people build more tax-efficient retirements. So let's get into it. Now, if you've seen other videos I've done on tax planning, you know I like to make a case for it as a going concern for virtually all retirees. I'll leave links to a couple of those videos if you want to check those out next. Tax planning matters because it's not just about what you make, it's more about what you take. And tax planning is at the heart of a number of financial decisions, even if you aren't retired. These are going to range from how you allocate your investments, to which accounts are best to use for tax avoidance, to strategic recognition of income, conversion strategies, gifting, etc. There's a lot of reasons to make choices like these, and even if you don't have an overarching goal like legacy or family, you can still prioritize tax planning into your decision making to help optimize what you take. But keep in mind, these decisions can't be made in a vacuum, and they're rarely going to be the exact same from person to person or year to year. It's going to be important to develop a framework of looking at a macro view of your tax planning and then a micro view of your tax planning on a recurring basis. So what exactly do I mean when I say macro? Well, the macro perspective focuses on the big picture of your retirement tax strategy. This includes long-term considerations and overarching decisions that affect your tax burden over your entire retirement period. This includes looking at projections of total federal taxes paid through life expectancy, paying attention to long-term allocations as it relates to tax drag, and understanding reallocation decisions in the same long-term context. This can also be pretty challenging on your own, as there are a lot of moving parts to a big picture view. I've seen comments in prior videos highlighting things like standard deductions or certain credits being high priority. What happens when RMDs kick in? What about net investment income tax? What about losing certain credits if income is too high, like those from the ACA? What about Medicare's IRMA? What about using distributions from IRAs to pay for the tax liability of conversions? Does something like that help or hurt? While there is no perfect planning software, many do work to address these concerns and do build in things like deductions, loss or change of credits, and changes in potential taxes, and these are part of their projections. So if you're worried about how a certain aspect of your specific tax life would affect the big picture or macro view of your tax planning, then you probably need a proper analysis with professional tools. Here are some key aspects of a macro view to consider. First is tax diversification, so balancing contributions and withdrawals between tax-deferred accounts like traditional IRAs and 401ks, then tax-free like Roth IRAs, and then taxable accounts like taxable brokerages. This can help to manage current and future tax liabilities. There's also withdrawal strategies, deciding when and how much to withdraw from each account to minimize taxes over the entire retirement horizon, factoring in things like required minimum distributions. Then there's concerns related to estate planning and legacy, planning for taxes on assets left to heirs, including potential estate or inheritance taxes. And then there's long-term tax rate expectations, considering how future tax policies might affect your strategy. Are there going to be potential changes in tax brackets or laws? You'd need a crystal ball to know exactly how things are going to play out, but even in the face of uncertainty, a macro view of your goal or time horizon is going to help give you a perspective on what your overall strategy on your tax planning should be. And once you have an understanding of your macro view, that's where the micro view now becomes incredibly important. And what exactly do I mean by micro view? Well, the micro view is focused on the details and immediate tactics within the broader or macro strategy, but it involves decisions that impact your taxes in the short term or on a year-over-year basis. The idea is to fit each year within the greater macro strategy, but you may have wildly different one-off years that require you to play a little planning jazz. Like, what if you retired at the beginning of the year, but then had a net unrealized appreciation opportunity? You aren't making any more earned income, but you might have income recognition in different ways that can affect what you should be doing with the rest of your strategy. You may have a one-off year of extremely high capital gains or passive income. What if you come into an inheritance that greatly increases your income in a given year or more? Just because you have a long-term strategy for your tax planning doesn't mean you aren't going to have to take a detour if your current year or situation dictates it. Here's some examples of what the micro view is concerned with, starting with this year's tax bracket management. And that can mean adjusting income or deductions in a specific year to stay in a lower tax bracket or maybe to avoid hitting a higher one. This can be crucial to things like strategic income recognition or hitting certain deductions or credits that you want or need. Also, there's this year's tax loss or gain harvesting. That could be selling investments at a loss to offset gains and reduce taxable income, or carry forward losses might be important to what you're trying to accomplish. Harvested losses become tax assets once realized, and you may only have a few opportunities at any significant tax loss depending on the year. You may also be trying to figure out where to pull money from for the current year's living expense and trying to figure out how the gain is going to impact the current year as well as the big picture. There's also this year's specific deductions and credits. Taking advantage of available tax breaks can mean being very purposeful in your income recognition and restriction on your adjusted gross income. Likewise, knowing if you should forego a deduction or credit to work towards a larger potential effect in the long term is something you'll have to weigh. And then there's also understanding this year's unexpected impacts. And these can come from anywhere but need to be accounted for in your decision making. So this raises an important question. How do you balance out the two? The macro and the micro view may perfectly align in any given year, but then be completely incongruent the next, depending on circumstances. You can't just say, well, the 30-year view says I have to do it. No, each year requires its own assessment, the merits of which are dependent on a lot of factors. Like I said before, just be ready to play some jazz. So if you have seen other videos, you're probably thinking, okay, well, you've shown us macro views before. I want to see a micro example. My intent with this example is to keep it simple, but try to highlight the opportunities and trade-offs someone might face within a given year. So we're going to be using two of my favorite people, Joe and Jane, and we'll work through some of their numbers. Namely, we'll look through tax year 2023, which was their last full year of working, and then we'll project this year, 2024, their first year of retirement. And we'll explore one or two opportunities that they'll be faced with. So let's set the stage on a few assumptions. Right off the bat, we're going to fast forward and assume that in our macro view, the next 30 years of their life project to have a massive tax savings by using early retirement years for tax arbitrage or tax avoidance. We'll also say this benefit appears to continue even past the 22% bracket up through the 24% bracket, and that if they run this strategy for roughly the next 10 years, they may even be able to fully convert their entire IRA balance to Roth. And so now from a practical standpoint, we have to ask the question, what does this year look like? What would they have to consider? What would they have to do? And what might they have to give up? So let's do a quick comparison of last year versus this year to see the difference. So looking over here, we're comparing 2023 versus 2024. When we look at their filing status, we can see that they are married filing jointly, and we see that it is just them and there are no dependents. Taking a look at income, so last year they had wages of $340,000. They had total dividends of $20,000 and then qualified dividends of $15,000. So one thing you'll notice is that this year, they're not going to have any wages. They retired at the end of 2023. So in 2024, they are retired and effectively job-free. Now, we'll keep these numbers the same in terms of the projection on total dividends and qualified dividends. These numbers are certainly going to change as the year wears on, depending on what dividends are actually paid out, and then if they have anything that might change the amount of qualified dividend that they may end up ultimately having. But at least for now, we'll stick with the same numbers. But as an exercise, somebody would want to keep track of how their dividends progress through the year, and they'd also want to try to keep up to date with that number because that number can become important. Income is going to be derived from a number of sources, not just what you make at a job, but also what you get out of your investments. There's a lot that's going to get rolled up into adjusted gross income. Right now, if you look, nothing in the Roth conversions. We'll actually come back to this. And then we'll presume they have just a little bit in the way of long-term capital gains again. And of course, this number could vary depending on what happens through the course of the year, but we'll assume some amount on the basis of what occurred last year. They have no other income from small business. They have no other income in general from rent or royalties. So what we're left with is for 2023, they had total income of $365,000. Now in 2024, they have total income projecting at $25,000. And we'll notice that the adjusted gross income matches total income in both years. Deductions are going to be a little bit higher in 2024 than what they were in 2023. And here we can see a difference in the taxable income. So 2023, they had a very high taxable income, just over $337,000. And then so far in 2024, they project to have zero in terms of taxable income. And why that's a big deal is right down here. We see that last year, they would have paid in total federal tax $68,252. This year, they're projecting to be at zero in total tax as it sits right now. And we can also see that they were in the 24% marginal bracket last year, so they have some familiarity what it's like to be in that zone. And then they had an effective tax rate at just over 20%. So what are their options right now? Well, option one is to do absolutely nothing. As we can see, this projects to give them a tax-free year, but what are they giving up in the future in order to do that? And option two is to strategically recognize some kind of income now, and then into the years that they have low income, they may want to continue to do that for the sake of tax arbitrage. And what do they give up to work towards those ends? You see, you can't have it all when it comes to tax planning. Do they want to plan towards lowest lifetime taxes and reduce tax drag? Do they have a mindset that tomorrow isn't promised and they want to make the most tax savings and credits that they can this year? Do they have an overwhelming desire to get cheap health insurance for the next 5 years before Medicare kicks in? They have to determine what matters most to them. And at least for the sake of this example in this video, we're going to run under the assumption that they want to reduce the lifetime tax drag on their money. They're comfortable going up in tax brackets to convert, but they really don't want to incur any Medicare IRMA issues or any other surtax along the way. And I do want to make a point with this that I feel is pretty important. Even after you are dead, the money that you leave to family can have tax consequences, and it can create tax drag. And you have to remember, tax drag is also a compounding effect. And so just like there's a myriad of things that could change in terms of their lives, their life expectancy, their family dynamics, their plans, you also have to look at the money itself as its own life cycle. What are the influences and things that will affect it? What is also going to have an impact on its value even after you're gone? These also have to be considered. So let's take a look at what it would mean in their situation to convert up to either the 22 or 24% bracket. And to do that, we're going to actually come and take a look at a chart that shows us what happens as their income incrementally increases. So remember that when you convert money from a pre-tax over to a Roth account, you have to recognize that income in the year of conversion. So what this is going to show us is for every $1,000 additional dollars that they add, what tax bracket do they fall into? What else might be triggered? And this gives us a nice visual to be able to explore what is possible when it comes to how much they could convert within those ranges. So what we can see is they can actually convert quite a bit while staying within the 10% federal bracket range. They can also convert quite a bit and stay within that 12% bracket range. But there is going to come a certain point where their taxable income will be high enough where capital gains starts to kick in. So this is something that they are going to have to consider as a first step. If this does trigger things like capital gains, are they comfortable doing that? They don't want the surtaxes that can come out of having adjusted gross income that is well above certain ranges, but how comfortable are they if they have capital gains that could have been avoided in order to try to work towards what that macro view shows them? Well, now we know. We've said they have some long-term capital gains that they have as a part of their situation or projection. So if they convert up to or past a certain point, there is going to be then an inclusion for some capital gains. But once that's accounted for, we can see that they can convert quite a bit and stay within the 22% bracket. And then at a certain point, they're going to hit the 24% bracket. And what this is showing us is that they would eventually hit net investment income tax threshold, but that's an additional surtax that can kick in if your adjusted gross income goes above a certain threshold and you have investment income. Then there's a calculation that has to be done to show how much of that excess investment income is going to then be taxed at that 3.8% surtax. So then they also have to decide how comfortable are they taking on net investment income tax. The macro view, this 30-year view, which tries to account for impacts of things, things like long-term capital gains, like certain surtaxes that would be applicable if your adjusted gross income goes too high. If that 30-year macro view is saying, hey, we've tried to factor in all of this over a number of years, and it still looks like there is projected value, and if that is significant, well, now is the put up or shut up moment, right? We're in this year. We can make a decision now as to what we want to do. If we go very conservatively down on this end, we could say, well, hey, last year I was putting money into that 401k. I was up in that 24% marginal bracket. Well, what if I just convert some of those dollars? What if I could get those at 10%? What if I convert even higher and then I get additional dollars at 12%? You can, of course, make that determination. You can also make the determination of, let me blow this thing out. We're going to ride it all the way up to the top, tippy top of the 24% bracket and maybe explore further. The reality of a micro decision is that it is this year. What are you going to do now? The 30-year range shows me this, but the reality of now is I have to either do nothing or I could do something. If I do something, am I ready to take on the additional tax burden that is going to come my way? And do I actually know what that looks like? Can I facilitate that? That is the point of a micro view. And so something to highlight before we actually go and take a look at how things will trickle down through their tax situation. This particular chart shows us that they could convert somewhere in the neighborhood of $225,000 in this year before they hit that 24% marginal bracket and before they have to worry about the added surtax of net investment income. And just for fun, if they wanted to, let's say, avoid having any capital gains and stay on the more conservative end of doing this, then this chart shows us that they could convert somewhere in the neighborhood of $97,000. Now we're going to come back over here and we're going to actually take a look at entering in some Roth conversion numbers and see how that actually trickles down through their tax situation. So we're going to put in here 97,000. This was the number that the chart showed us they could do and avoid having any capital gains tax. And let's see how that plays out. So the first thing to note when we come down, we have total income. Now it's showing at 122,000. Adjusted gross income showing at 122,000. We're definitely under the range where you would have to be concerned about Medicare's IRMA if that was a concern. And we're also well below the range where you'd have to be concerned about the surtax of net investment income tax. And then coming down further, we can see that their projected total tax in the situation or scenario of converting 97,000 is just under $8,300 federally. That puts them in the 12% marginal bracket. That gives them an effective rate at just under 9%. And then just another quick note, we can tell that we're basically in the zone where they're avoiding capital gains tax. So here's where this can get additionally difficult. What if dividends end up being higher? What if there is a surprise capital gain distribution that you weren't expecting that occurs at the end of the year? What if for some bizarre reason you receive a K1 off an estate that you had no expectation of? There can be these things that can occur that you don't necessarily anticipate that can have an effect or impact on your tax planning as well. So in practical terms, oftentimes people will try to have some sort of strategic recognition, but they don't always necessarily try to get right up against that threshold of, all right, well, now I'm tipping myself or I'm going off a cliff into a surtax. A lot of times you will give yourself a little bit of cushion just in case there's something unexpected that happens. And now we'll take a look at what happens if they convert all the way up to $225,000, like we saw on the chart as well. We'll note total income here projects to be right at $250,000. Adjusted gross income projects to be right at $250,000. And then their total tax projection, just over $37,000 federally. This has them within the 22% bracket, and then their effective tax rate is at 16.9%. And so how do we highlight these opportunities? Well, if they do the conservative route, if they do the more aggressive route, if they even go the ultra aggressive route and decide to go, well above this $225,000 on the conversion end, they have to be ready to take on the liability that is going to be presented to them. They have to be ready to facilitate whatever it is that they want to do. And keep in mind, if they do this, if they decide to go ahead and recognize this income, whether it's at the more conservative or if it's at the higher levels, they are going to have to forego things, like being able to qualify for Medicaid if that's what they wanted to do, or to try to qualify to get the ACA credits and have that lower health insurance. So we have this macro view. The macro view says we've tried to account for these things. We understand that there can be a wide range of variance, and that variance can grow as the years go by, but we're trying to see, is there any value available? in a 30-year view, could you see some sort of tax savings? And if so, what does it take to get there? And if the software is presenting you with an option that says, well, if you got aggressive and you try to convert in these low income years before things like Social Security kick in, before required minimum distribution age, if you were to try to take on that approach, it projects to give you significant value. If that's the case, you still have to come back every year and decide, am I committed to this thing? Can I facilitate it? Are there any legislative changes that have gone through or look like they'll go through? But what do I need to do right now that's going to be within what I am comfortable doing and can facilitate? And what do I have to give up to do that? And this is an ongoing decision. This is not I'll do a decision once now and then every year I'll just follow through. No. Tax planning is something that has to be revisited regularly, because your situation can change. It can change even without you doing anything to change it. Again, by virtue of dividends you didn't expect, special dividends, maybe less qualified dividend than you thought you'd have, capital gains that you didn't think you would have, life events that you didn't think you'd have where you had to go and access money. There are myriad of things that can influence the micro. The micro is obviously going to then influence how the macro plays out. So to prevent this video from being 4 hours long, we've used just a very simple example. We've tried to keep it as streamlined as possible, but there can be a lot of complexity to your situation, to other situations. So take this with a grain of salt. Take this for what it's worth. It is an example that we threw together to try to create an understanding of the concepts. But really, this is to get you thinking. There really were no favors done in pushing out the required minimum distribution age, and there really weren't any favors taking away stretch provisions from inherited IRAs. So keep those things in mind as well when you're thinking about what are your tax planning opportunities. So if you got something out of this video, I'd love a subscribe. If you think I missed something or have another way of looking at this you think people need to see, let me know down in the comments. My hope is these videos can get you to start developing your own positive framework around the planning needs of your retirement years. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.